Good morning, this is Wayne Bilal with another Smart Profit Maximizing Moment. Today we're going to talk about a subject that is boring, unless you make a mistake. It's avoiding the mistakes that people make when they make an entity selection. And this happens all the time with businesses that have been around a while that decide to open a second business or buy real estate, new businesses. And it came to my mind that I really ought to cover this, and I had somebody come in and see me in my conference room here. And I'd done a bunch of research on Google, and it was basically completely wrong. It's not the first time I ran into that. But she was right about one thing. She went and got help before they did anything. All right? That's important. And I've run into that a lot. To give you an idea, I had somebody I met with. For whatever reason, we didn't end up working together. We weren't a good fit. But at least the one thing we did is show them that they were paying an extra $40,000 a year in Social Security taxes because of the way they'd set up their entity. It's not unusual for me to see higher audit risks, much, 10 to 20,000, 10,000 or more in taxes being paid that you shouldn't have, excessive accounting fees for doing tax returns that probably aren't necessary yet. So let's talk about that. Your entity selection, what I'm talking about is how are you going to be taxed by the IRS? It's very simple. You really have four choices. You can be a regular corporation, you can be an S Corp, you can be a partnership, or you can be a sole proprietor. Now, let's talk about one thing, get it right off the table. I'm an LLC, so I file an LLC return, right? There is no such thing as an LLC return. For the IRS, if you try to find an LLC tax return, you won't find one. It doesn't exist. You have those four choices. Others are out there, like being a trust and things like that. But I'm talking about for businesses, all right? So an LLC is a chameleon. It can be whatever I want it to be. So first, if I do an LLC and get a federal ID number, I'm going to get a letter from the IRS, or I'm going to print one, download it, that says, congratulations, you're going to file as a sole proprietor if you're only one person, or if you're two or more, you're going to file as a partnership. Now, that's the default position from the IRS. Anytime the IRS defaults you into something, pretty much can be guaranteed it might not be in your best interest. Okay? So what we need to do is look at why. The biggest thing that happens when I default into a partnership or a sole proprietor is once I start making money. So let's say I'm making money and I get to $100,000 in profit. Let's just use that number. And I'm still a sole proprietor, or I'm still a partnership. Well, I not only pay income tax at whatever the partners or my rate is if I'm a sole proprietor, but I also pay Social Security on all my earnings, which is 15.3%, a little bit less than that because you get a deduction, but let's just keep it simple. So I'm basically paying an extra $15,000 in tax on self-employment, which, to be honest, because of all the other things that happen, like, putting my income on my tax return, and then I get to use the standard deduction. If I'm married, that's $24,000. So now I'm only taxed on $75,000. And then I get the 20% Section 199A deduction. So, I've reduced that by another $15,000. So I'm at $60,000. If I have a couple of kids, that are under the age of 17, I got $4,000 off. I might have other things going on too. So my income tax is often lower than the $15,000 self-employment tax. Self-employment tax is the highest thing. So the one mistake that we run into is not switching from a sole proprietor or partnership to an S Corp. All right. So an S Corp is, people think it stands for Small Business Corporation. We'll go with that, but it's actually subchapter S of the IRS code where it's defined. No big deal. What that does is that it's a pass-through entity. It files a tax return as if it was a separate entity. I take the LLC, I make the election to be an S Corp. And a cool thing about this is that I can actually elect after the year end. I can look at my tax return and go, if I have the LLC, and 2019, 2020, I'm having a big year, I can elect to have S Corp status. Now that would require me to file the 2553, which, go see your CPA, your tax preparer, and make the, elect to be treated that way even though you filed late. It can be done. I've done it over a couple hundred times, never had one turned down. All right, if you know what you're doing, you know how to do this. All right, get help. All right, so what's the advantage? Well, the advantage is now if I made $100,000, I have to pay myself a fair salary. Now, when you're working and making a profit, profit comes from two or three things. It comes from my work, it comes from my employees, it comes from my equipment, it comes from my systems that I have in place. Now, I shouldn't have to pay Social Security on all of those, just on my work. So I set a fair salary. What's a fair salary? Well, that's up to judgment. You know, it's a facts and circumstance thing, which means, you know, every one of those is separate. So we have to sit down and see what's a fair salary. And we usually have a range, let's say 40,000 to 80,000, you know, 80,000. Now we want to go on the low side as much as possible. It's a startup business. We're still doing that, whatever. Now, the truth of the matter is the IRS seldom challenges that because it gets kind of tricky. They might as well go after somebody who's not paying themselves a salary, which is a big mistake if you have an S Corp. All right. So what happens? Let's say I set my salary at $60,000 and I made $100,000. $60,000 I'm paying Social Security on. That means $40,000 I'm not. That means $40,000 times 15%, just to keep the math simple, I'm saving $6,000. All right, $6,000 per year for 20 years, 30 years. How long am I going to be in business? 10 years. So I'm looking at 60, 180, 60, 120, 180, 200,000. And if I make more, I'm saving more. All right, so it could be easily that. That's how big an entity selection could be. I mean, even if it's just 60,000 over the next 10 years, can you use that more than the IRS can use it? Probably. It's as simple as that. Now, there's some cost involved. All right, so one of the costs is I actually have to file a corporate tax return, which is going to be more expensive. You're going to spend probably $1,000 to $1,500 more. All right, that's probably the biggest cost you have. All right, so you're going to spend more with CPAs. A second mistake I see, though, is people take themselves and make themselves a C Corp, which is a traditional corporation. It's what most of the literature talks about. Most of the accounting literature talks about. It's what we have when we have the the big companies. Because one of the problems with an S Corp, two problems with it really, is one, I can't have more than 100 shareholders, and two, I can't have any foreign-born shareholders. So I might be stuck as a C Corp. Now, a C Corp, the problem is it pays its own tax. The S Corp pays no tax. It just passes it through to the owners, and the owners pay the tax. The S Corp pays it, the C Corp pays the tax. Now it's at a flat 21% income tax rate, which if you make more than 50,000, you're better off than you were under the old law. Okay, so that's another problem. Second problem, though, is that you have what's called double taxation. I pay tax at the corporate level, and then if I want to take the money out, because that's why I have a business, I'm trying to, improve myself, make some money, take care of myself, my family, my community. So if I want to do that, I have to take the money out somehow. I either have to take it out of salary, which I'm going to pay Social Security and Medicare on, or I take it out as a dividend and have double taxation. So we never put businesses that are going to take out most of the funds into a C Corp. We're not supposed to. I see it all the time done. It's hard to fix. All right, so it's better to do this right at the start. So that's a problem right there. I'm not going to get into it much more. Probably the third biggest mistake is creating an S Corp or a C Corp for something that probably shouldn't be. Let's say I have real estate and I'm renting it out, and I'm an LLC. Remember, it can be ignored, in which that means I don't have to file an LLC return. I put it on my personal return. Well, there's no advantage to put it in an S Corp or in a C Corp. You never want to put real estate in a C Corp, because when it appreciates in value and you sell it, you pay the corporate tax, and then you have to pay an individual tax as a dividend. So we don't want to do that. That one's out. There's no reason to put it in an S Corp, because why pay the accounting fees when I can just put it on my own tax return, Schedule E? And why don't I care? Because you don't pay Social Security on rental properties. Now, I had covered a lot there, and that's really kind of the basics, but it kind of covers the three biggest mistakes I see. So go back and watch this. But now let me end with, if I'm in the wrong entity, can I fix it? Probably. Might be more expensive than we want, might not want to, might be more difficult, but if I'm going to save $10,000, $20,000 a year, definitely be worth it. Get with a CPA that knows this area very well. Hey, until next time, this is Wayne Bilal saying, let's make this our most profitable year ever. Thank you very much.